Welcome to Supernova Stock Watch. This video, we are looking into investing in Dividend Aristocrat ETFs and the secret to making money. Individuals looking for income-oriented investments may be turning to dividend stocks, which are enduring a less volatile year. The appeal, despite not offering price gains, has remained consistent and offers a major source of current income. Safety is at the forefront of dividend-focused investments. They offer a reliable monthly payout and have less market volatility compared to stocks, which will help you stabilize your overall portfolio. Investors that are looking for a more predictable stream of income may find equity markets a little too volatile and prefer investing in dividend-paying securities. It's also been shown that these low-risk investment products provide higher long-term returns. There are plenty of different dividend ETFs to go with, but zeroing in on the Dividend Aristocrats in this market environment could be a smart move. Higher inflation and Fed rate hikes have made the markets tense, while geopolitical issues make it even harder to plan ahead. The term Dividend Aristocrat is applied to companies that have been in existence for at least 25 years and have increased their dividends each year for at least 25 years. These companies generally provide a degree of stability during times of economic difficulty and offer downside protection with large dividend payouts. Additionally, aristocrats tend to skew the portfolio to low volatile sectors and mature companies. Alongside their other advantages, these stocks pay dividends. That makes them a secure and rewarding investment for the long term. They have great fundamentals, with a sustainable business model, a solid track record of profitability, increasing cash flows, good liquidity, and plenty of room for growth. Further, a history of strong dividend growth indicates that dividend increase is likely in the future. Investors, you should know that Dividend Aristocrat funds are more likely to offer higher dividends growth than other funds, but they don't always have the highest yields. Further, these products lead to a healthy portfolio with a greater scope of capital appreciation as opposed to the simple dividend-paying stocks or those with high yields. If you are risk-averse and plan to hold any investments for the long term, these products could be a good way to balance out your investment portfolio. We have highlighted some popular ETFs that could provide growth with less risk of a sudden market crash. The first ticker on the list is SPDR S&P Dividend ETF, ticker SDY. This ETF has provided a well-diversified exposure to 119 U.S. stocks that have consistently increased their dividends for at least 20 consecutive years. This can be done by tracking the S&P High Yield Dividend Aristocrat Index. Each firm accounts for less than 2.6% of the assets. They have $20.3 billion in assets under management, charge 35 basis points and trades an average of 574,000 shares daily. Next one to mention is Schwab US Dividend Equity ETF, ticker SCHD, offers exposure to 105 high dividend yielding U.S. companies that have a record of consistent dividend payments supported by fundamental strength based on financial ratios and ample liquidity. This can be easily done by tracking the Dow Jones U.S. Dividend 100 Index. This fund has $34.1 billion in assets under management, charges 5 basis points and trades in an average daily volume of 3.2 million shares. Third, on the short list is a must-look, which is the Vanguard Dividend Appreciation ETF, ticker VIG, is the largest and the most popular ETF in the dividend space. The fund follows the NASDAQ US Dividend Achievers Select Index, which is composed of high-quality stocks that have a record of raising dividends every year. Vanguard Dividend Appreciation ETF holds 267 securities in the basket with none accounting for more than a 4.7% share. They currently have $64.5 billion in assets under management, charge 6 basis points and trades on average volume of 2.1 million shares. Fourth on the list is iShares Select Dividend ETF, ticker DVY, provides exposure to the companies with a consistent 5-year history of dividend payments. It follows the Dow Jones US Select Dividend Index, and holds 102 securities in its basket with each accounting for less than 2.7% of the assets. iShares Select Dividend ETF has 20.6 billion assets under management and charges 38 basis points in fees per year. It trades an average daily volume of 1.2 million shares. Fifth on the list is iShares Core Dividend Growth ETF, ticker DGRO, provides exposure to companies having a history of sustained dividend growth by tracking the Morningstar US Dividend Growth Index. It holds 418 stocks in its basket with each accounting for less than a 3% share. iShares Core Dividend Growth ETF has accumulated $22.9 billion in assets under management, and charges 8 basis points in fees per year. It trades at an average daily volume of 2.3 million shares. Coming in sixth is the Wisdom Tree US Quality Dividend Growth Fund, ticker DGRW. This ETF tracks its own Wisdom Tree US Quality Dividend Growth Index. It offers diversified exposure to U.S. dividend-paying stocks. with both growth and quality characteristics like long-term earnings growth expectations. It has gathered $6.9 billion in its assets under management and charges 28 basis points in fees per year. This fund currently holds 299 securities in its portfolio, with each accounting for no more than a 5.2% share. It trades in volume of 510,000 shares on average. The last one I want to mention, saving the best for last, is the ProShares S&P 500 Aristocrats ETF, ticker NOBL. This fund provides exposure exclusively to the high-quality companies that have not just paid dividends but have raised them in at least 25 consecutive years, with most doing so for 40 years or more. It follows the S&P 500 Dividend Aristocrats Index and holds 64 securities in its basket, with each accounting for less than 2% in assets. The ProShares S&P 500 Aristocrats ETF has amassed $9.7 billion in its assets under management, charges 35 basis points, and trades in an average daily volume of 708,000 shares. Now to keep us motivated about long-term investing, looking at the secret of making money with the power of compound interest. We start off with an initial investment of $2,500. We invest a max of $6,000 per tax year, which is $500 a month prorated over a 12-month period. We'll set a goal of investing in our retirement account for the next 20 years. On average, we'll see a 15% annual interest rate, with a combination of share price increase and dividend payments. We'll compound the interest on an annual basis. The projected results would be over $590,000. If this sounds doable, check out my next video, How to Live Off Your Dividends Faster. Thank you for making it to the end of my video. Please check out my other videos and also check out the description for great deals and sign-up bonuses.